Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, October 15th, 4:35 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video, the Big Show version, where we go through the prior week, take a look at the key levels for next week, and update the world-famous 21 over 21 leaders list. We'll also talk about some portfolio changes that we made. Let's get right into it. State of the market. Back to uptrend. This occurred yesterday with a classic O'Neill follow-through day. This means what we look for is at least 4 days off of a bottom, a powerful move in the indexes, accompanied by some strong leadership from leading growth stocks. And we checked all the boxes for that, including, and the volume was there also. That's a key component. So our market leaders indicator on the trend gauge back to bullish. A lot of good action from a lot of leading stocks. And then today we got our second close above the 21-day exponential moving average for the, all the indexes have had at least two closes above the 21. So we went back to uptrend there. Medium term, we've got one close above the 50 on the S&P, and the NASDAQ 100 has not quite gotten above yet. So we're still neutral from a medium term standpoint, but note the arrow pointing toward bullish. Long term, going all the way back to July of 2020, we're still above the 200-day moving average. So what happened today? I talked about the follow-through day on Thursday. We had a second gap up today. Sometimes that can be some red flags. You don't want to go too far too fast. This was also day three off the intermediate bottom. And then we had a not so nice reversal in small caps in the afternoon, although after with small caps being up strongly over the last 3 days, not really a cause for concern, just a little bit of digestion. And that was echoed by the G5 index, which closed negative. But again, the G5 the prior 3 days up 1.05%, up 1.13%, up 1.65%. A flat day for the G5 is certainly okay. It was up stronger, up much, really strong, along with the S&P early in the day. But as I said, gave it all back, just some profit taking into the weekend, and certainly entitled to do that. S&P up 0.75%, NASDAQ up 0.6%, Dow the leader up 1.1%, mid caps up 1/10, and the Russell down 0.4%. Let's get to some market facts and charts, but first let's get to the team running Revere. We're a conflict-free, completely transparent, registered investment advisor. We put video content out 6 days a week, 5 videos and a podcast. And what we do is we follow the trend of the market. That means when the market's in an uptrend, we're following that trend along with the market. When the market turns sideways, in a weakening aspect, or even turns bearish with the breaks of key moving averages, then we get the heck out of the way. We've been doing that. We had been doing that over the prior couple of weeks, but that changed on Thursday with our follow-through day, along with some good action in leading stocks. And if you're interested in an approach like this, basically the point is to make sure that you don't get hit upside the head with the 2x4 that happens with bear markets. If you're interested in this approach, you can give us a shout. You can email any of us, Dan, Tim, Hunter, Mural, Alex, or Don at revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. Let's get to the market facts here. So I mentioned second gap up, small caps close red. Let's go to the S&P 500 here. Let me blow this up a little bit. And so where are we? Let's go back to the beginning of September. We topped the beginning of September, rolled over. Remember, all bear markets, and by a bear market, I'm going to talk about the traditional definition is a 20% down move. This starts out with normally a 12% down move, because that's typically the distance between the top and the 200-day moving average when the top occurs. You can see that was 11.8% right here. This is what my studies of bear markets have proven out. So if you're going to break the 200-day moving average, you got to first break the 150, the 100, the 50, the 21, going all the way back up. So as we break the moving averages, you're going to see stocks weaken. Our stops are going to get hit. You're going to have less setups and deterioration in the indexes. And as all these things happen, we pull back a little bit from the market and we wait to see what happens. So the first thing happened mid-September. We broke through the 21 but held the 50-day moving average. Then we had this big ugly day down on 9/20. The 100-day moving average is right around this area too, not showing it on this chart, but it appeared to be just one day down. We bounced right back up over the next couple of days, but we couldn't maintain any kind of momentum above the 21 or the 50-day moving average. Had another ugly gap down on 9/28 that followed through to the downside where we had some consolidation. And then 10/7, we got a curveball in the market. Hey, the debt ceiling, they reached an agreement to avert the debt ceiling, and we had a big gap up. Everything's fine, right? Nope, couldn't hold the 21. We had another 4 days down, and then we had this spike low and with a hammer, which means we gapped down but finished near the top of the range. And at this point, we're counting from the bottom, which was 10/4. 1, 2, 3, 4, 5, 6. So on day 7, we put in this hammer. But we didn't have a follow through because the volume wasn't there and we were only up 0.3%. But we stopped going down at that point and then gapped up on 10/14. Strong day. This was on Thursday. Closed up in the S&P 1.71%. Also on the NASDAQ, closed up 1.8%, and the NASDAQ had stronger volume than the day before. That qualified as a follow-through day. We saw good action in leading stocks, and basically we're following a formula that has been designed by William O'Neill, and it's timeless. You see the same characteristics of tops and of bottoms, and this is just one of the characteristics of a market bottom. So we increased exposure yesterday, a little bit more today. And one of the things that we want to see here, so let's go back to the facts. The only headline today was that retail sales topped estimates. There's really not that big a deal. So headwinds and tailwinds that we're dealing with right now. Rising interest rates and a strong U.S. dollar. This is a very clear headwind for stocks. It's the correlation's been sticking very strongly. However, tailwinds, sentiment is negative, which is contrarian bullish, and the put-call ratio is high. That's another contrarian bullish signal. When we see these, the reverse of these, if we see strong sentiment and the put-call ratio low while the market is at a high, that's considered a red flag, but we're seeing just the opposite now. So the tailwinds were in place for the follow-through, and that's what we got on Thursday. Sectors today: financials, industrials, tech, and consumer discretionary, led by Amazon, up 3.3% on the day. Also transports and metals. So some nice action from some key indexes. The only big red flag today, uranium, which had been a hot sector, was down, and gold, silver, and gold stocks were down also. There's the closing numbers on the day, as I mentioned, up 0.5% at the open, up 7.5% at the close, underperformance by the G5. Now, what are the bulls looking for? I wrote this yesterday. We want to get above and stay above the 21-day and the 50-day moving average. So we've got 2 closes above the 21 now, so that's consistent with what we want to maintain the bull case on the S&P, and we've had 1 close above the 50-day moving average. So we're good there. And what do we want to avoid? Statistics show that if you have distribution, which means a down day, a significant down day on higher volume than the prior day, that usually throws cold water on the rally. So that's what we're looking for over the next couple of days. If it happens in day 1, 2, or 3, there's a high rate of failure. So that's the bear case. That's what we're trying to avoid. Day 1, we dodged that today. Let's go to the NASDAQ 100 now, and you can see 2 closes above the 21. That's the green line. It's also turned and hooked up. That's what we want to see. We've got the 8 hooked up too. Ran into the downtrending, kind of flat, barely downtrending, 50-day moving average, and that's where we closed the week. What we want to see next week is to get back above that and stay above it. Again, that's part of the bull case that we want we want to see. But same situation here. We topped in September. You've got the same or similar gaps. You've got the bottom put in on 10.4, and then the rally and then the follow through on Thursday, up 1.84% on higher volume, and then nice day today. Dow Jones Industrial Average also looking good. There's your gap up last week on the debt ceiling, but 4 days down, put in the hammer. Second gap up now. 2 closes above the 21, 1 close above the 50. Let's go to mid caps now. The mid caps and small caps, we've been talking about this for a while, this long consolidation. We got up to the top of the range today and reversed on mid caps, so maybe we just need a little bit more rest. We've got all these moving averages, the 50, the 21, the 8, the 100 is also in there, all stacked together, and they're all flat. So we need to see continued progress to have those hook up, and we're still above the black line, which is the 200-day moving average. But again, at the top of the range, we had a second gap up, mid caps and small caps reversed. Mid caps held on to very slight gains. Here's small caps, not quite as close to the top of the range. You can see this big triangle that we broke out of on Thursday. Another gap up today, but we reversed. We're still outside of this triangle. And we've also got all of these moving averages here that throw the 200 in with the 50, the 21, the 8, and the 100. They're all gapped together here. So that should provide a lot of support if we come down and they start angling up to potentially bounce off there and propel higher. On the other hand, if it fails, that's just part of the bear case. If it fails, we'll change our tune. But as for right now, leading stocks, okay. The indexes working in our favor. We're working under the assumption that the market is back to a bullish condition until we get information to the contrary. So here are the key levels on the S&P. Let's bring the S&P 500 back up. And really all this is paying attention to various levels, and these dictate the health of the market. I've got arrows here on four different situations where we started the week. We were down here in no man's land in the prior pullback range, but again, part of the bull case, we wanted to get above 44.65. That's the highs from 3 weeks ago on 9/23. We closed the week there, so we can check that off. We wanted to get above 44.36. That's the flat 50-day moving average. We've got one close there, so we're bullish there. The 10.7 high, which was last week, 44.30, we wanted to get above there. We're firmly above there now. There's the 10.7 high. And we wanted to get above the 21-day exponential moving average and also have that moving average turn up. So we can check that off on our bullish list too at 43.98. That'll be above 4,400 next week. So should these fail, and then we go back down and we start investigating or testing these prior levels that we bounced away from toward the end of the week, and that is 43.90 to 44.30. That was prior resistance, but we're above that now. No man's land in the prior pullback range, that's really 4300 to 43.90. That's this area all in here. And then below there, we've got 43.67, the 100-day moving average, and then the bearish line in the sand for right now is this 4,300 level. We get below there and the market is definitely taking on a different tone than what we're seeing right now, and we'll react accordingly. And then below there, we've got the 150-day and the 200-day moving average. We're now 7% above the 200-day moving average. That's down at 41.71. So here's the cases, and all we do is, observe the facts. As long as we maintain above these bullish levels and leaders continue to act fine, we'll continue to increase exposure at low risk entry points and let this bull market carry our accounts and our stocks higher. So that's the facts, Jack. And let's take a look now at some individual positions. And let's start with what got booted out of the 21/21 this week. Just 2 stocks. One of them that we bought in the middle of the week and got stopped out of today. We had a nice consolidation here on Celsius on Wednesday, and we entered it here. Normal to encounter resistance at the 100 level, and it did that several times. So when it pulled back from there, low risk entry, low volume. But then we saw some selling come in on Thursday. We closed right on the 21, and then we broke that early in the day today. So took about a 5% loss on this on a 0.25. I'm sorry, on a 2.5% position. So just a paper cut. You want to make sure that your losses are paper cuts, and then when you get a strong trend, it makes up for all of them. So Celsius booted out, and we also got stopped out of it. And the other one I took out just from a diversification standpoint, we had too many software stocks in there because another one that we bought got added in, but DigitalOcean, a little bit extended too after this big run up, pull back to the 21. This is still a decent chart. The pullback has been on below average volume compared to the up day that we saw on Wednesday, but it did reverse off the highs and replace this with two stocks that I'm going to talk about here in a second. So let's go to the 21 over 21 list. Let's show the whole list first of all. We have 12, 11. We've got 12 different industry groups. I always try to keep at least 12 in there. And so these are industry groups, and we've got 18 different sectors. I'm sorry, 12 sectors, 18 industry groups. Multiple industry groups comprise a sector. So there's the full list, and they're sorted in reverse order, which means reverse order of when they've been added to the portfolio. So the first one I'm going to bring up is the newest addition to the portfolio, and we own ITA, which is the aerospace ETF, and there are several leading stocks in there whose charts pretty much look the same. So we took one of those and added it to the list. This is a nice flat base that actually put in a little bit of a handle here, Raytheon, and showing nice relative strength over the last 5 weeks, little pullback into the 21. And this is very similar to what the ITA ETF looks like. You can see the move off the bottom of the base, a little bit of a handle, bounced off the 21, and we own a 5% position in ITA in the GROTECTION, Blue Chip Income, and Robo Plus portfolio. So, and the second one that we added was another one that we took a position in, and this is Crowdstrike. Crowdstrike, a former leader, formed base over the last couple of weeks, was not acting as well as some of the other stocks. So we owned it, we sold it, but always keep an eye on it. And then look at the volume. The volume dried up down here under the 21, under the 50, and then a big burst of volume on Wednesday. It got back above the moving averages, up 7% on 50% above average volume. We bought it back here, followed through on Thursday. Nice tight inside day on lower volume. Say this is exactly what you want to see from a consolidation standpoint. An inside day on lower volume, which means the high and the low of today were below the high and above the low of the prior day, and volume was lower. This perfect consolidation day, and we'll be looking to add to this on any strength. So CrowdStrike, also, we own it, as always. If it's red flagged over here, we own it. So let's go through the rest of the list. Live Nation, an reopening stock. You can see the relative strength looking good. Silvergate, this is putting in a handle after a nice strong run up. This is usually when cryptos are strong. This is strong, and Bitcoin and Ethereum have been strong the last 2 weeks. Putting in a little bit of a handle here with earnings next week. Digital Turbine. We own this back here, got stopped out on it. This is one of the dirty 30, but it's forming this nice long base. You can see all the blue bars here of accumulation as it's trudging higher. Looking good, Digital Turbine. Net, shaken out of this one on this 5 days below the 50-day moving average, did not buy it back, and this is just really jaw-dropping strength for a stock this size. 12, 13 straight up days. Any weakness on this is very clearly a leader. Any low risk entry point, I would love to get back into it, but for now, very clearly missed it. Here's Ethereum, pulled back at the top of this nice consolidation that it's had over the last 4 or 5 weeks. GBTC a little bit stronger, and also apparently they're going to approve a futures-based ETF next week. That gave Bitcoin a little bit of a spike, but you can see the relative strength over the last 3 weeks on Bitcoin. But ETHE is what we've got in the 2121 list, and that might change next week. SBNY, Financials continue to be strong. This is one of the strongest. Very nice. Palo Alto Networks, we also own this. Nice move off the 21, nice relative strength. Look at this. This is a great looking relative strength line, starting with the gap up on earnings. When you gap up on earnings, day 2, day 3, higher high, really no give back. Came into, look, while the market was pulling back, this was going sideways. So that's why you can see relative strength continue to climb up while price goes sideways. That's exactly what you want. And then it was one of the first ones to make a move off the 21 and head toward higher highs. So we've got a position in that. Airbnb, another reopening play, terrific relative strength. It's gone sideways now for a couple of weeks as it sits on the 21 here. CBRE, real estate development company, price forming this double bottom-ish with a handle pattern, nice relative strength, and some diversification with it being a real estate company. Tesla, finally, really breaking above this 800 level with some conviction this week. They've got earnings next week. They've reported good sales. So we'll see. They've reported good sales already. So we'll see what happens with Tesla. We do have a position in this also. BTU coal putting in a handle here on lower volume. Lots of false starts on this one. 3 days out of the last 5. It's been strong, but has closed at the bottom of its range. Snapchat bounced off the 21 today with some volume. Earnings next week. Bill, a strong software stock, this little cut base that it's put in, all-time highs, pulled back above the 300 level. Looking good. Affirm, small position in this one, got shaken out of it when it pulled back here, but look at how the volume has increased over the last week and a half. This is one that is acting like it really wants to be a big leader, and any advantageous entry points that we get, we'll be taking advantage of them. Ambarella, this is our biggest position. We initially got into it back here when it gapped up, sold a little bit of it in this area when it was testing the 21, added back to it twice on Thursday with the big volume move up, and had a gap up this morning but reversed at all-time highs, kind of typical. Might need to just put in a little bit more of a handle here before it continues to the upside. Devon, strong energy company, had its 20% move up going sideways over the last 2 weeks as energy continues to be strong. Upstart, another probably the strongest stock in the market, from 281 to 400 in the last week and a half. Got shaken out of this below the 21. Didn't reclaim it while we were waiting for the market to right itself, and it's another one that got off without us. Datadog broke out again, pulled back, bounced off the 150 level. And finally, Mosaic, agricultural companies strong, which is typical when energy is strong, broke out of this nice cup base, consolidating over the last 5 days, and that's your 21 over 21 list. So as far as the portfolios go today, I talked about the ITA that we added this week. We added and got stopped out of CELH, added Crowdstrike, added to AMBA. We also, on the follow-through day yesterday, with IWM breaking out, bought some TNA. I'm going to show IWM because these decisions, it's a leveraged ETF. The decisions are always made based on the underlying, but this breakout from this tight range got us into TNA, and we also own QLD on the QQQ, move back above the 21. So we've got SSO, QLD, and TNA, leveraged ETFs, and BROS, BROS, small position in this, this is forming an IPO base, came down, consolidated for about a week and a half here. When it got back above the 50 level, the 50 level is like the half Livermore level, and it's kind of treated as a support and resistance area just because it's 50. You see it all the time. You see the same thing around 100. But when we broke back above 50 and then pulled back, we got a small piece of this. This has a potential to be a big rival to Starbucks, and they're just getting started. But the canceling methodology has traditionally had a ton of big winners in in restaurant and food and retail type stocks. Think about Chipotle. Think about Starbucks. So let's see what will happen with this one. So those are the changes to the portfolios, and that's going to wrap the video. As always, let's take another look at the market facts and the key levels that we'll be keeping an eye on next week. As long as we stay above this 21-day exponential moving average and these levels above there that will naturally be above, as long as we stay above this 43.9821 day moving average, which is now going to be around 4,400 next week. As long as we hold above there, we're in good shape. If that fails, then the rally's probably going to fail and we'll pull back and decrease our exposure. But as always, like to hear from you. I'm on Twitter at @dvandenbord. You can email me, don@revereasset.com, or phone 855-REAL-WEALTH. Wrapping up the week ending 10/15. This is Don Vandenbord telling it like it is. Thanks for listening and have a great day.